While some online bullion dealers continue to charge $4 over spot for US Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend Dave Kranzler. Dave, it's great to have you back, and perfect timing here.
Thanks for having me back. I love being on this show with you guys.
Yeah, thanks for buying all of the metals, too. Big market move.
Yeah, that was me pushing them up today.
Yeah, that sure is the story today here. Obviously, the big move in gold and silver began this morning on the jobs report release right at 8:30. Expectations had been for upwards of 200,000 jobs last month in May, and they came in at 38,000. Terrible miss. I think it's the worst in, almost 6 years. Worst jobs report in almost 6 years. So basically, gold and silver instantly spiked as the market, which looks like it totally priced in or rate hikes the next week, unpriced that rather quickly. And we were kind of chatting before the show. I have the feeling, my gut tells me that the Fed orchestrated this terrible jobs report today to give itself a way to back out of rate hikes. So why don't we start with the market move today, the jobs report, and what your take is on all of it, Dave?
That sounds good. You want me to talk about what happened in the metals today?
Yeah, the metals today and what your take is relating to all this nonsense about rate hikes.
Are the metals higher today?
Let me refresh here.
You're getting downright giddy, Dave.
Part of my thesis for the last 3 weeks has been that the Fed, part of the reason, the motive for the Fed to come out and pound the table on threatening us with higher interest rates is that they're specifically targeting gold, the price of gold. Because we had a big run up in the price of gold since mid-December, and it was starting. I really feel like it was starting to turn into a runaway freight train for them, and I think they had to do something to sort of tame the animal spirits in the market. Because if you notice, as soon as it was literally the right before, I think it was 2 Mondays ago or something, when the Fed governors, the regional Fed presidents started coming out in tandems day after day, threatening us with higher rates in June. The June meeting's a live meeting. I guess all the other meetings weren't live. They were fake meetings. And it correlated almost perfectly with the sell-off that we've had in gold. And as we were discussing earlier, there was a lot of fear in the market about the open interest. And it's true, the open interest had run up quite a bit, and there was frothiness in the amount of large spec. They call it large spec. It's really the hedge funds in their long position, in their net long position, and the commercial sector, which is largely the bullion banks and some hedgers in there, had gotten to a pretty high net short position. But on a relative basis, as a percentage of the overall open interest, the net short position of the banks was not. It wasn't out of bounds. It wasn't indicating to me that we were going to have a huge pullback necessarily. That doesn't mean that they wouldn't engineer one, but what we had, the gold got well above its 50-day moving average and well above its 200-day moving average. And historically, we've had usually when that happens, there's some type of technical correction, whether it's part of it's manipulation, but part of it's just natural ebb and flow of markets. It's not 100% manipulation. And so last week, gold sold off down through the 50-day moving average, and it was kind of sitting halfway between the 50-day and the 200-day moving average. Mm-hmm. And in the last issue of the Mining Stock Journal, I told my subscribers, I said, I've been expecting the possibility of a 200-day moving average pullback in gold, as it's been a common occurrence over the last 15 years, and right now it's sitting between the 50 and the 200 DMA. But I had also said, late last week, which is when this issue was released, we started seeing some strength come back into the mining stocks. And the mining stocks had been hit pretty hard while gold was going down. But on Thursday and Friday, the mining stocks seemed to be kind of resilient to any kind of weakness in the metals. And I thought that might be indicating a possibility that the pullback could be over. So, again, the jury's out here. I'm still not discounting the possibility of a sell-off back down to the 200-day moving average. I'm noticing today that gold basically is right back up to its 50-day moving average. And again, who knows if the technical funds are going to start kicking in and selling on Monday if gold doesn't move back above the 50-day moving average. But I do think that the massive washout that people were looking for based on the Commitment of Traders report, the way that was structured, I think the risk of that has substantially subsided because, Eric, as you had mentioned, the open interest in gold contracts is now down over, about 100,000 from its peak. And that's a huge decline in open interest in just the last week, basically.
Yeah, it's amazing. I don't remember all the numbers off the top of my head, but in January we were below 200,000 for gold on COMEX, and now we had seen licking up at about 600,000 and dropping down about 500,000 or so in the last couple of days.
It's below 500,000 now. I just pulled it up a few minutes ago. I think I saw it at like 480. Here it is, right here. 481,000. But what's interesting about this open interest report, and we've already had a record amount of gold delivered on the COMEX, whether or not the actual physical gold gets delivered. The amount of gold that's been reported since first notice day, which was May 31st, the amount of gold reported in those 4 days, essentially 5 days, is a record amount of gold. I guess it'd be 4 days. And there's still 740,000 ounces worth of June contracts open, which is a lot at this point in the delivery cycle. So let's give them the benefit of the doubt and say that this physical gold is really changing hands. There's some people who want delivery of that gold. And to me, I find it interesting, especially because the size of it is so unprecedented.
Yeah, and we've seen a pretty interesting shift when it comes to putting all of this on a calendar basis for the chronology of what has been going on. May, we saw the dollar essentially move up from that first day of trading. We sliced down 92 on the DXY index to 91 and change. And it was only a couple of days later that whole jaw-boning fiesta began with the Federal Reserve. And it's clear that they weren't only just freaking out about gold and this precarious position with the dollar, but maybe even a little bit concerned about how they're going to be able to market all of the bonds that they need to market to finance the U.S. government debt. So this looks like we just went through a period where pretty much most other markets weren't doing that much. If you look at oil, it didn't change that much. If you look at the stock market, it hasn't seen significant moves. We did see a shift in the trend direction for the long bond. But other than that, really the fireworks has been in precious metals and currencies. And I think that this has largely been a kabuki theater exercise for a period of the entire month of May. And now we're reverting back to the direction that the market's fundamentals would like the markets to move. And that is a lower dollar, higher gold price. And eventually lower stock prices. And, they're going to have to deal with this bond bubble as well at some point. And that's part of why they do the job owning that they're doing, is because they're in a rotational game that they play, and it also includes the global macro layer where they're playing games with their compatriots and central banks in the Bank of Japan and the ECB primarily.
Yeah, it looks like the metals are likely going to continue the move into next week, Eric. They're both melting up here into the close today. Miners are melting up into the close. A lot of the miners are up 10 to 15% or more today. It's impressive.
Yeah, and the dollar's move as well was pretty big. Go ahead, Dave.
I think part of that is when the sell-off started mean, there was a day, I think maybe it was 2 weeks ago, when the JNUG, triple levered
Yeah.
junior bull ETF. I mean, that thing was down like, I don't know, 40 or $50 in a day. I mean, it's just a huge move. And I think part of what you're seeing today is there's, the hedge funds, these momentum black box trading hedge funds, once something starts moving in one direction or the other, they pile into it. So I think they were piling into shorting these stocks, because some of these stocks, I mean, half the stocks on my screen are up over 12%. And one of the ones that's one of the most heavily shorted is up over 15%. It's Golden Minerals. It used to be ECU Silver.
Oh yeah.
And that one's always been one of the most heavily shorted mining stocks in the world. So part of it's short covering, but there's a lot more. There's more interest right now in junior mining stocks than I think I can ever recall seeing in the last 15 years.
Yeah, well, it's similar to that 2002, 2003 period, like you've talked about before. We talked about that on, I think, our last show.
Yeah,
and
that's right.
It definitely has that feel to it. I mean, people are like, down and out and dejected when it comes to miners, and all of a sudden, within the last couple of months, they have been coming back. And the sector is so small that the size of the flow is having an outsized move on the equities.
I mean, I agree, but I actually think that there's a wider audience that's playing in these junior mining stocks than there was back in 2002 and 2003.
Yeah, could be. Well, we have a lot more money sloshing around. That's just the nature of our fiat and the world in which we find ourselves.
That's right. There's more money sloshing around, but I think there's also more awareness of the sector. And these, let's face it, the junior mining stocks, relative to the price of gold and silver, were cheaper in mid-January than they were when the bull market started in late 2000. So, part of it is, I think, fundamental based, not just day traders chasing profits.
What we saw in the physical markets today, really across the industry, all the wholesalers and the APs, and what we're seeing with the order flow at SD Bullion, and the bullion market, demand has been just exceptionally strong. We talk about it every week in the show. Mint sold another million silver eagles this week, bringing May's numbers to basically 4.5 million, third highest month of the year and the highest month since February. But today, physical bullion buyers, I think best word to describe it is really shell-shocked. And the market kind of died to almost a standstill, because I think everybody for the last week or so has gotten used to 16 and was actually kind of hoping to get an opportunity to buy back closer to 15. And the big move today, everybody's just shocked that the move, really, $30 move in gold, and 50-60 cents over the last 24 hours in silver. So, but what we typically see is after the second to third day of moves higher, everybody starts to realize that trends changed and they better get in and come rushing back in. So it'll be interesting to see next week if the move continues, if the strong physical demand picks right back up. I'd be looking for it probably somewhere around Tuesday to Wednesday.
Hey, Dave, what do you think about the summer doldrums thesis? You believe that we're going to have it this year?
You mean in the precious metals, or just the markets in general?
Precious metals for the most part, but I guess you can address equities generically too.
Nah, forget equities.
Well, if people are running out of the stock market, that'll help metals.
Probably
for sure.
just have more of the summer insanity in the valuations of the general equities. But well, the summer doldrums concept came about because what would happen is that India's second largest seasonal buying period was the spring, and would sort of subside in early May. And so the market would run up in the spring, and then India would disappear. China wasn't, they may have been quietly in the background, kind of running like your antivirus on your computer, but they weren't really that visible back in let's just say from 2001 to 2008. And so, and what would happen is that the bullion banks would start going, after the run up in the prices, the bullion banks would start going to work on the precious metals and start hammering them throughout the summer. And then they'd have to stop hammering them again in late August, because then India would come back into swing, leading into their largest seasonal buying period, which is the fall, it's ahead of the Indian festivals and wedding celebrations periods. So that's kind of where this concept of the summer doldrums, it's kind of like the sell in May and go away thing. I mean, is it really true anymore? Well, no, because everyone assumes you sell in May and go away, so the next smarter people sell in April or sell short in April and wait for the people in May to sell and go away, and then they cover their short. So the market eventually kind of adjusts. But now China is not running in the background like your antivirus. China's very open, and they're buying, while there's some seasonality to it, they're constantly buying year round. I mean, they're just accumulating so much gold. What's interesting about India is India's been dead because of the jeweler strike going on over there, protesting the excise tax that the jewel, I guess it's an export tax that they incur when they export their jewelry. So there hasn't been much gold buying going on since March 1st. There's been some, and now there's doré bars that there's been the importation of doré bars has picked back up. But at some point India's appetite is they're gonna have to start buying regardless, because they don't really produce their own gold. They import everything. So at some point they're going to have to start buying gold again. And that, again, I think the China factor and that combined with the India factor, I don't think we'll get a summer doldrums period. And as we were talking before we started the podcast, we've had a record amount of gold delivered month to date. And I just wanted to pull up the delivery report just to see where the buying was, if it was the house accounts for these banks or if it was the customer accounts. And I'm looking at it, and if you look at just the deliveries that were made yesterday, almost all the deliveries were on behalf of customers. So Macquarie Bank was almost half of the deliveries, and it was on behalf of their customers issued that. But the ones that are stopping it are largely the customers also. And I don't scan the delivery reports all the time the way some people do, but there's a company that showed up that I haven't really noticed before, and that's not to say they haven't been there. I just haven't noticed them. And they were a pretty major issuer and stopper of gold yesterday. I mean, they took delivery of quite a bit of they took almost 10% of what was delivered yesterday. It's called International FC Stone Inc. It's some Fortune 500 company. It used to be called Farmers Commodities Corporation. And like I said, it's interesting that they're kind of showing up on this list, because I've never really noticed it before. And that's not to say that they haven't been there, but it indicates to me that there's new people coming into this market looking to buy physical gold. And so I think that's another factor that'll sort of offset this expectation of a summer doldrums.
Yeah, that makes sense. Well, it's going to be a hot summer. We are definitely going to be shaping up for outside forces to impact metals for sure. With the presidential election and geopolitics is definitely on the back burner as well. The issue with Greece was never settled. We have Brexit vote coming up. That probably also was a major factor in terms of turning tail at the Federal Reserve and them backing off on jawboning, because they've been trying to paint a picture of raising in June with only, I think, 7 days separating the FOMC meeting and the Brexit vote, and that's just not going to happen. So we are shaping up for a pretty hot summer. It's going to be fascinating to watch, and I don't think we're going to see summer doldrums, in part because of all of these other additional factors layering on top of a new bull market being rebooted and people wanting in, and the standard equity markets, generally speaking, going down for the remainder of this year. I think that's going to be a big tailwind for precious metals. Time will tell.
And if they don't raise rates in June, and you're looking at towards September, the question starts to rise. Do we really think the Fed's going to raise rates in September, a month and a half before a presidential election?
There is the July meeting.
What they saw,
so they could conceivably.
There is the July meeting,
but I don't think they're going to do it. I think this has all been a jaw-boning session, and the proximity towards the election is going to make them fearful of being labeled being too political.
Yeah, I think the closer we get to the elections, the greater the percentage goes down of a chance of rate hikes for exactly that reason. They don't want to be seen as political, and they can see as much as anybody what happened in the markets the last time they raised rates.
Yeah, Janet is not having a good day today. Somebody give Janet a double martini. Grandma needs it.
I don't think there was ever any intent to raise rates. I think it's all been jawboning the whole time, and again, I think part of it is, they were targeting specifically gold to try and cool off what was going on in gold. And the stock market never believed that they were going to raise rates, because the stock market never went down and during any of this. In fact, the stock market was kind of drifting higher while all this higher rate talk was going on. If anything should be affected if they raise rates, it should be the stock market.
Even the dollar's failure to get past 95 on the index is another indication of exactly that.
That's a good point.
And when they did their jawboning, I was figuring, okay, they're going to reset it. They're going to try to get a little more space in the dollar such that it can fall later in the year. So maybe they'll try to get it to 97 on the DXY index, but they weren't even able to get it out of 95 handle. So, this has been a 1 month mirage. That's really the bottom line. We've seen markets being painted in all different directions, and it's been an artificial move, and now we're reverting back to the fundamentals.
That's right. And, these guys have access to much better data than we get access to through the public channels, right? So if the data that we're seeing is indicating the U.S. is going into a recession and the economy is sucking wind, these guys have to know that. If they don't know it, they're just complete blathering idiots. And I don't think most of them are really that bright to begin with, but I don't think they're that stupid. They have to know what's going on even better than we do with the real data, the real economic data. And there's no way that they don't know that the payroll report is completely rigged.
Pretty easy to know that when you're rigging it.
Exactly. So should we move on to the employment report? Because I wanted to sift through some of the numbers to just show how unrealistic it is. My feeling is, the expectation was 158,000. The actual came in at 38,000. And I think the real number was probably very negative. I think the economy lost a lot of jobs. And if you break down, if you look at the actual household data, the two key elements that are the hardest for them to fudge are the civilian non-institutional population and the civilian labor force. And they're saying that the civilian non-institutional population grew 205,000 from April to May, yet the civilian labor force declined by almost 460,000. So they're saying that the civilian labor force, let's just call it 500,000 people left the labor force. So to be part of the labor force, you either have a job or you fall into their definition of looking for a job. And if you don't fit either of those two categories, then they just remove you from the labor force. And so they're saying almost 500,000 people left the labor force last month. Is this really the kind of economy where you think people can just decide, oh, well, I've been looking for a job, but I can't find one, so I'm just going to go live on my savings, when you find out that something like 70% of all Americans would have trouble scraping together $1,000 in an emergency, I don't think I don't think these people just left the labor force. I think that number was managed lower, in order for them to show a 4.7% unemployment rate. Because they're saying that the number of unemployed dropped by 484,000. So, I mean, you didn't have 484,000 people find jobs according to their numbers. So what happened to those people? You know, I think a bureaucrat just takes his pencil eraser and erases them. I really think that's how they do it. So,
well, in a longer term, that's exactly what ends up happening, because the so-called employees transition into permanently discouraged workers, and they drop off of the statistical rolls. And that's why we have 94.7 million people indicated as not being in the labor force right now. So yeah, I think that's the highest number ever, if I'm not mistaken. It's certainly it's on par with the highest numbers, if not an absolute record.
I think you're right, because the last time that the labor force participation rate was this low was in the late 70s, and
Yep.
most households were still largely a one-income household. You know, most women still kind of functioned as housewives. So now you got most households are dual income households. So, I mean, to me, that's really telling when you've got 50% of the population is now potentially wants to work, and yet your labor force participation rate is back to where it was when that 50% of the population was not necessarily looking for work.
Yeah, and when you're talking 94.7 million and putting that in the context of the decades that have transitioned since that 70s print, you know, I mean, our population in the United States has got to be 100 million more, give or take. I don't know what the number is off the top of my head, but it's quite
Exactly.
significant.
It's the 94.7 is a horrifying number. I mean, it's almost a third of the U.S. population.
Yeah, and that's
So,
including,
I mean,
you know, kids. So
I agree.
population in the United States about 320 million or so, give or take.
Yeah, exactly. I agree. You know that they, you know, part of the reason for printing 38,000 jobs number instead of the blowout over 200,000 number we've been getting for the last several months was politically motivated to make sure the Fed really doesn't raise interest rates in June. But I think they kind of knew they weren't going to raise them anyway. And then if you look at the unemployment rate, 4.7%, you know, the Fed's out there saying that the labor market is tight. Well, with the numbers that we just reviewed, how can they possibly say the labor market's tight? I mean, there's so many people who can't find jobs, they just stop looking. But if they're going to go with that, narrative, you have to look at that 4.7 unemployment rate. And at least when I was studying economics in the 70s and 80s, anything below 5% was considered the economy's too hot. We have to raise rates. So I don't know. It's a baffling. I mean, every time they release this employment report, it baffles me. But this one is probably one of the most baffling I've ever seen.
It's like the swinging of a pendulum. They were manipulating upside. Now they got to, you know, clean up the mess that they made.
Right, but then the 4.7% that's what you would think. But then the 4.7% unemployment rate, you're just like, huh? Really? So, and what I think is the most interesting is the market's reaction to this, because if the idea was that, okay, we're going to print the headline number of 38,000, a huge miss, you would have thought that, you know, well, yeah, gold's going to shoot up because, oh, that means no rate hike in June. But the stock market sold off hard until Europe closed, and then they managed to push the S&P well off its lows. It closed down 6, but at one point during the day it was down, I don't know, it was down like 11 or 12 points. So, and the Dow only closed down 31 points. I think it was down close to 150 right after the market opened on that number. But the thing of it is, well, if they're going to print an employment report that's geared to let everyone know they're not raising rates, why would the stock market sell off? I think that's kind of economic reality hitting home in the stock market, which is, oh yeah, maybe the economy really is as bad as all these tinfoil hat conspiracy theorists are trying to tell us. So that's my take on the events today.
All right. Well, before we wrap it up, guys, what's your take short term here going forward into the next week? Do you think everything's been repriced back in? Do you think the correction's over? Just quickly, each of you give me your thoughts on where gold and silver are at short term here.
Go ahead, Eric.
As I sit and take a sip of coffee. Surprised me. I think that we're going to continue to see the summer months be a positive for precious metals, and that there will be no summer doldrums. And sure, we're going to see a lot of volatility and whatnot, but the general assumption that average conventional market participants, the 95 some odd percent of conventional finance money under management worldwide, is going through an awakening process of realizing that we've got a bond bubble, a stock bubble, currency insanity, and precious metals rebooting in a bull market after a 4+ year hiatus. And all of these big trends are things that the average 95% or so money under management are becoming aware of, with the courtesy of Soros and Stanley Druckenmiller and others who are high profile making their moves, and people are beginning to understand what the heck's going on. So that, combined with all of the global macro and domestic dynamics that we talked about earlier in the call, with the presidential election and geopolitics being a big factor as well in the summer months going forward, I think we're going to see a really strong summer. So, short term next week, I think we're going higher, and over the course of the summer, we're going to grind higher too. I don't think it's going to be really hard to see gold by the end of this year. Maybe even well into 1,500 handle, give or take. And people, now looking at the gold with $1,243.50 closed spot basis, looking at Kitco quote, and seeing that kind of a move between now and the end of the year would surprise a huge amount of people. And I think that that's what we got in front of us. And the momentum will build over time as more and more people recognize these shifts. And when you see a giant move like Dave was referring to earlier, when it comes to like the JNUGs of the world going up, what was it, $35 today? Pull that quote here just because it was up $39.46, and a move of 39.98% in a single day. I mean, that kind of a leap is the kind of leaps that people see when we have shifts in sentiment. The same thing happened with the dollar. We saw the dollar index on DXY decline 1.67 today, down to 93.91. That's a giant move in a currency world. And it speaks to the recognition of a lot of hot money and the managed money of the 95% world of conventional thinkers, recognizing, at the margin, because prices and markets are always set at the margin. You see these big moves that are expressing shifts in sentiment. And even though this is a single day and only, a certain set of data points in various markets that we can look at, I think it is, in fact, an inflection point, and that it speaks to the failure of the jawboning and management of perspective economics song and dance we've gone through in the entire month of May, and now it's unraveling and reverting to what are, in fact, the real fundamentals, and people are recognizing it. So I think we're going to go a lot higher, and the standard equity market's going down in the remainder of this year, and that they are linked.
I agree with everything Eric said. That's why I wanted him to go first, because I'm tired. No, I honestly, I don't have much to add to that. I second everything Eric said. I do think, if you want to just look at the next week or two, if you just look at gold and silver in isolation, you might say, well, there's still some moving averages that need to be overcome, and that people might still be a little bit nervous about another washout, sort of, the summer doldrums worry. But if you look at what the mining stocks are telling us, they're telling us a completely different thing, because the Huey index never really traded below its 50-day moving average. It kind of, the last 3 or 4 days, 5 trading days, it's scaled along the 50-day and moved higher along the 50-day. And I would have said that maybe I guess would have been last Friday, maybe last Thursday, was a little bit of a relief rally in the sector. We're going to have more weakness ahead of us, but it never went below the 50-day moving average. They tried to take it and close it below 200 a few times this week, and I mean, today you just had such a huge jump. I mean, it completely jumped up and is kind of waving by to the 50-day moving average again. And to me, that's kind of foretelling of, I think it might be volatile, but I think in general, I think that the trend is going to be higher for the next few weeks, if not longer.
All right, guys. Well, I concur. That's why I let you both go first. So, but it'll be nice this weekend to drink our coffee and looking at our screens, and everything's pretty much everything that I see is up that I want to own or I own. So it's a good feeling, and hopefully it'll carry on and continue into next week and the summer like Eric's looking for. So
there's a party at Doc's house.
I sure hope
everybody's invited this
we'll have
weekend.
A party at Doc's
Barbecue
house.
on.
Who's having the party?
Party's at my house, Dave.
I'm there.
All right.
You can text me your address.
We'll post it for all the readers. We won't tell Mrs. Doc
Dave will bring
that
100,000 people are coming. You better get the food ready.
I think probably 50 would show up. She'd freak out just for that. All right, so we'll call it a wrap there. Dave, it's always good fun to have you back on the show, and we always enjoy your great knowledge of the sector.
Well, thanks for having me. I appreciate it. I don't know if I have a lot of knowledge about the sector, but I like to talk about it, and I've been impassioned about it for the last 15 years. So I'll come on anytime you want me to.
And besides that, he's got wisdom. He lets somebody else go first. And all right, so we'll wrap up the show there. So for the Doc and Eric Dubin and Dave Kranzler this week, thanks for tuning in to SD Weekly Metals and Markets.